This is the book I was talking about. You might want to read in 20 years or so when you're starting to worry about your family, but it's a good book. We have a couple of articles by him. It's a book. I thought it meant on being mortal, but it's actually just being mortal. And he talks about end of life kind of things. One of the points he makes is at the end of life, a lot of people are more restricted, more isolated, more confined than a felon in a high security prison. And he talks about how bad that is and that we should let people have their freedom. And he goes through this because he's going through this with his father. And so he's a doctor looking at it from a medical procedure, but also from his father's. You can see the subtitle, Medicine and What Matters in the End. And they say eye-opening research. It's a tough book. It's not necessarily all that pleasant, but he's the one that's part of this study that said we do all this at the end of life, and surprisingly, it may not offer long life. People who go to hospice live 25% longer. So all that protection, all the confinement, we actually probably shorten their life and make it much worse. I hope it in my life they'll let me, have a dog if I trip over it and die. I mean, that's my choice. Or some guy that's been smoking his whole life say, "Oh, you can't smoke. It could shorten your life." So it's like, I'm 98 years old. Give me a break. Shorten my life. A cigarette. Let me do it. So let people have their freedom to the end. If even that means they may die faster, you have to obviously worry about liability laws and those kind of things. But it is a good book. He is a good writer. It is not a fun book to get through though. It's a little bit on the negative side. All right, let's finish up this last big group of comments from this one book from the Cato Republic. We talked about this, women having mammograms in their 40s. Remember, there was a study done really early that said it saved lives. And then later they redid the study and discovered it was actually the opposite. It actually harmed more lives than it saved. But the whole industry was set up to do this and it was making money. And so, so what happened when they say, "Hey, don't do this anymore"? Prominent doctors piled on. Time magazine quoted this doctor. He was appalled and horrified. There's no doubt that mammography screening in women under 40 saves lives. Yeah, there is no doubt. What else is also true? It also harms lives. It also shortens lives. So it's not the question, does it save a life? If it saves 2 lives but destroys 15, that's the question. But no, it's what he says exactly right. It's no question that it saves lives. To recommend women abandon that is absolutely horrifying to me. But what's his answer to the actual analysis that was done? The balance tilted negative because mammograms generate false positive findings, which cause women to undergo unnecessary treatments for tumors that pose no risk to their health. So, yeah, if David Dershaw was here, he could defend himself, but this book obviously is saying it wasn't a strong argument. All right, so I don't know, you could put this under fraud. I'm not going to go back to our outline, but you might note some of this. The pharma sector, just pharma alone, because hospitals and doctors are in there as well, donated $3.3 billion in congressional campaigns, 43% more than the second largest contributing industry. Hospitals and nursing homes contributed $1.4 billion, physicians and other health professionals $1.2 billion. There's $5.6 billion. That's $735 per legislator per year coming from this industry. Y'all see why Robert Kennedy, he's using that against his own peers in Congress when they challenge him. Not I'm saying that he's right, as he's obviously very controversial, but he has a strong argument on that side. So they generated substantial campaign contributions for politicians and lobbying firms. Congress loves this thing because what Congress does, I think we talked about this before, they do something that harms hospitals and doctors. They don't like it. So Congress passes a bill to delay it 1 year. And so what does the industry do? They have to provide them more contributions so that next year they'll vote to delay it 1 more year. So Congress has figured out how to get as much out of this process as possible. It's like, we won't cancel it forever. We'll cancel it for 1 more year. And next year we'll see, we're not asking for more money next year, but we'll take it if you send it to us. It's quite the little scheme. So I don't know who's more unethical here, the industry or the Congress. I remember one of Trump's best lines in the debate with Clinton was she was complaining about the taxes he paid. He goes, "Yeah, you were in Congress and you passed that, so why are you blaming me? You're the one that passes the law." So whom are you? You know, the pot calling the kettle black. You know, that was one of his stronger lines. Is like, if you don't like it, then change it in Congress. Unnecessary medical costs account for 30%. So there's that 30% you see a lot under waste and fraud. You'll see the 30%. It's the low end. Some people say as much as 50%. Here you see the 50%. How much waste and fraud? This is talking about waste, unnecessary medical care. What by unnecessary means, it's medical care where there's no evidence it's improving lives. You saw that wonderful graph I gave y'all that was really, really powerful. With total spending now $3 trillion, Americans waste $1 trillion on healthcare in just 1 year. That's $400 billion more than it spends on national defense. We could reduce medical spending by 50% without damage to our health. Health policy experts know that we are at best only weak aggregate relations between health and medicine, in contrast to apparently strong relations between health and many other factors such as exercise, diet, sleep, smoking, pollution, climate, social status. Cutting half of medical spending would seem to cost little in health, but yet would free up vast resources for other health and utility. Really similar to in that second article, we spend all this money on it. Is that absolutely the best place for it to spend our money? Could we find more efficient places to spend the money? 100 seniors, I don't know where to get this data, but I can promise you if you get the book, there will be a footnote there and they'll say exactly where they got it, what article it came from. So they are very, very well documented. The 100 seniors die a day from medical procedures they didn't need and shouldn't have received. A lot of waste in the system. I can't remember what this is, but you can look at it. I put a chart in there. I thought it was pretty good, but I can't. My eyesight's not good enough. Yeah, here's another fraud case. This person gave one of his patients 155 chemo treatments over 2.5 years, even though the patient was cancer-free. So there's definitely some fraud in the system. How big that is, as a percentage of the overall, is hard to say. Remember, there's that one claim that for every $1 you spend on fraud, you can reduce fraud by $8. So you've seen that it is somewhat sizable from that standpoint. So here's an example of waste. 2 plastic surgeons charged more than $250,000 to sew precision, a task done by a resident during a previous operation. Why? We talked about it before. You got these 2 plastic surgeons who don't have enough to do. Let them do it. They can overcharge the system, even though someone much, much, much cheaper could have done it. Here's the surprise bill discussion. And one way surprise bills come up is you have doctors in the hospital that aren't in the network, that aren't employees of the hospital, so they can charge separately. A few exceptional hospitals do require all doctors to be part of the network. So it is possible to solve this problem. But other hospitals say, hey, you know what? That's better for the patient, but what about for us? Hospitals see no advantage in protecting patients from surprise bills. Why? It's in the hospital's best interest to do it. It's in the doctor's best interest to do it. And so I love that, and you'll see this a lot in this book. Surprise bills are a consequence of lack of market competition. That's their main thing. Insurance and the government make healthcare act unlike any other industry in the United States because of this lack of competition. It's not a true market. Okay, so can Medicare and Medicaid reduce waste and fraud? Medicare and Medicaid receive something like 3 billion claims per year. If one human were to spend time on this, 5 minutes on each one, it would require 125,000 people working 2,000 hours. Obviously, the computer's doing this. maybe AI, something's reviewing this, but 3 billion claims a year, that's a lot of claims. You assume, US only has 300 million people living in it. That's 10 claims per person, and this is just Medicare and Medicaid. So, this is a lot of claims. How many of those are fraud? Who knows? But there's got to be some fraud going through the system. Yeah, you saw this in the movie. Healthcare providers that harm their patients can make more money by doing so. They get paid once for delivering a service that injured the patient and a second time for treating the injury they inflict. This may explain why healthcare providers harm patients so often. I would put that on the quality of healthcare. If you get paid for low quality, then your incentive for high quality is pretty low. This is part of my solution is this information on quality should be provided to patients, should be advertised. It should be something patients seek out and demand before they go into a hospital. And it's something hospitals should be required to report. Instead, if you don't report it, you have low quality, you actually can double up on your revenue. Research has found that patients at the worst American hospitals were 3 times more likely to die and 13 times more likely to have medical complications if they had visited one of the best hospitals. Yeah, that goes under difference in quality, cost and quality. Here's medical care quality controls. That first quote we talked about works there. So inconsistent costs and quality city to city. There's a great quote for that. I'm on page, I didn't put the page numbers in here, but research has found that patients at the worst hospitals 3 times more likely to die, 13 times more likely to get medical complications. And the issue this study found is most hospitals don't even know where they stand. Why? Because they don't make any money by improving quality. If you can increase your income by having higher quality, you spend money on quality. If not, you're actually making money with low quality. Why would you bother? I think I told you a story about the CFO was offered this procedure to reduce error rates, and he's like, "Why would I do that? That's going to cut my revenues." So that's how heartless the system can be when it's not graded on quality and it has no incentive on quality. Yeah, this is a great quote. Are politically controlled. So they're blaming government and insurance. You're going to hear that over and over again. This system that has heavy political involvement and heavy insurance involvement has taken away any business case for improving quality. There is a moral case, obviously. There's an ethical case, but from a pure net present value to say, should we spend $1 million to bring our death rates and our error rates down? The MPP says no, because there's no financial benefit to doing that. You should know that when you walk into a hospital for surgery, right? Wouldn't that be a good piece of information to know? Oh, I'm walking in to have surgery and they have no incentive not to harm me. So yeah, I might want to get some information on this hospital. The connection between price and quality is far weaker. It can be inverted. The better providers charging less than inferior ones. Patients don't know this. So what? They use price as a signal. So here's a system where price is not a signal. There's no relationship between price and quality, but that's all the patient has. So they assume if they're getting charged more, it must be higher quality, and there's nothing, there's no relationship there. All right. Let's talk a little bit about Medicare. This is where some of these quotes should make you mad as a young person. Medicaid coverage increased annual medical spending by $1,172 per household. The winners are about 35%, use about 35% more medical services than the losers. Having Medicaid coverage made only a modest difference in their health. So we changed the law, spent a lot more money. There were people that won, they got a lot more medical coverage. There's people who didn't win, got less medical coverage. In the end, the winners were no healthier than the losers. spending more money through your government system doesn't improve health. It just spends more money. Why? Because that's what, when people become eligible for Medicaid, it's hard to come up with better evidence that the demand for medical treatments is in fact quite elastic. People spend more on healthcare because they are insured and buy more insurance because of the high cost of healthcare. I mean, it's a circular argument. They're just making the case. This is not a competitively run market economy. This is one that's been distorted by the government, distorted by insurance. There's no relationship with what we're spending and the outcomes. There's another graph that may be interesting. The less we rely on ourselves, the more we spend. So the more insurance you have, the more healthcare you get. That should be pretty obvious. Sometimes in some of these, I'll actually highlight something in the footnote. You might, if you see some of those, go and, because look at this one. This is research statistics, data, and system statistics, trends, and reports, national health expected data. It's a really long website, but you might find something really interesting there to add into your 5 points. That's why I highlighted it. I can't, you'll have to find it in the article itself. But yeah, I mean, I love how well they documented everything. So I wish I could copy and paste this in, but I can't. But yeah, I mean, there's some really, really good websites out there. All right. Right. So you're paying for Medicare. A typical one-earner couple can expect to receive medical benefits worth $427,000 after paying in only $70,000. A two-earner couple, they get $427,000 in benefits for a price of $102,000. Part B premiums now cover only 25% spending on physician services. So people are paying, your grandparents paid $70,000 and they're getting $427,000 in benefits. They're paying Part B, Medicare, and they're only paying for 25. So who's paying the rest of that, do you think? It's the people sitting in this room, right? You're paying for so Thanksgiving, when you hear your grandparents complaining about, wow, man, they should, on Facebook, I saw it, senior citizens shouldn't have to pay property taxes. It's unfair. So this is what I come back with. Yeah, they should. They get huge breaks that are getting passed on to your generation. Medicare's administrative costs. Well, I'm going to skip through this, but some people say the reason insurance and healthcare is so expensive because insurance companies have all these expenses. They got CEOs. People argued Medicare is better because it's a lot cheaper to administer. Those numbers are quite debated. Part of it is that Medicare, a lot of their expenses are pushed on the other departments and governments. If you think about it, the IRS collects all their premiums, takes a lot of their administrative work off of them. Corporations collect Medicare taxes and send them to the government. So Medicare outsources a lot of what they're doing that most health insurance companies have to do. So this says when you adjust for that, Medicare's administrative costs for $509 per primary beneficiary compared to private sector costs of $453. So it really depends, and obviously there's a lot of debates. It's debatable. I'm not going to say these are the right answers, but if someone says Medicare is cheaper because it doesn't have all these salaries and bonuses, CEOs, and all those kind of things, Medicare's actual costs is not the true cost of the program. It pushes its costs and outsources it to other people, and it does it without, it has complete power to do it. Corporations have no choice but to collect the premiums for Medicare. You can see there, this is Cato. History provides no basis for believing that the government will ever improve quality, reduce spending, or get fraud, waste, and abuse under control. Yet Medicare for all proponents persist in thinking that the government will magically run an enormous single-payer program better than it ever has run any other healthcare program before. The U.S. government appears to be unusually subject to pressure from special interests and usually incapable of rationing. I'm not saying Mondani is not going to be successful, but this is the Cato side of the argument. Why would government be any more successful than the private sector? And I would argue the private sector at least has incentives to get costs down, to be innovative, to be high quality. The government doesn't really have those incentives. It doesn't mean that they won't, out of just pure, they're just their moral, maybe they're more moral than the rest of us. Those of us in private business, we're just unethical, and everybody in government are these angels walking around just doing great things. But the Cato Institute doesn't believe that. And part of the reason they don't believe it is because government's already been involved in healthcare, and there's no evidence that they're any better at it than the private sector. All right, so here's the LASIK argument. The real price of service fell by nearly 30%. Why did LASIK and cosmetic procedures become more affordable? Consumer demand, first-party payment. What does that first-party payment mean? No insurance. Competition. By comparison, over the same period, LASIK and cosmetic surgery became cheaper. The prices of medical services covered by insurance rose 2 to 3 times. Yeah, I think I am going to copy that one in. That one fits really, really well, right at the very, very top. Under the inefficiency of the insurance model. And under technology, it could go either one. I'm going to put it in both places. I like it under technology because some people say, well, the reason healthcare costs are so high is because of technology. We have all these new technology improvements, and LASIK says, yeah, so do we. In our field, technology made our services cheaper. Everywhere else, technology made them more expensive. Why is it? And it's not because of technology, it's because of the incentives in the system. So what about retail clinics? Some people say, hey, they're not really skilled to be able to do this. The AMA medical profession contends that retail clinics endanger patients by using simplistic decision and treatment protocols, disrupting patient-doctor relationships, overprescribing medications, and fragmenting the delivery of healthcare. These assertions have little or no empirical support. In fact, when it comes to treating minor illnesses, retail clinics often achieve better quality scores than physicians. Conclusion was clear and probably unambiguous. Remember, I typed all this myself. Retail clinics provide less costly treatment than physician offices or urgent care centers with no apparent adverse effect on quality of care or delivery or preventive care. How much less costly? 40 to 80%. I'm gonna copy that down to the solution under alternatives. Consider lower cost models. Retail clinics is one of those things. Remember Porter's idea for the most complex stuff, fly them to Philadelphia, fly them to Houston. For simple stuff, keep it local, keep it cheap. You don't need specialists to do those kind of things. So it's very consistent with what Porter's saying. I'm not saying for complex care, I'm talking about urgent care. Someone breaks a bone, slips, gets a scrape or an infection, something that retail clinic can handle. They can do it cheaper and they can do it better. Here's some medical tourism. If you want those, hysterectomy costs $32,000 in the United States, $4,000 in Thailand. A kidney, $150,000 in US, $25,000 in Philippines. American couple can expect to spend about $20,000 for a round of vitro fertilization here. In Israel, $3,500. That sounds like a good airfare expenditure, doesn't it? $16,000 cheaper. I don't know if does insurance cover vitro fertilization. I don't know if it does or not, but if not, there you go. You can fly to Israel for a couple of $1,000. I mean, does the husband really need to go? I guess he does. I don't know, but maybe it's 2 airline tickets. So anyway, y'all can copy that if you like into that same spot. The world famous Cleveland Clinic, $100,000. This surgery is directly cheaper, $1,600. In India, there's India again. New Hampshire mortality rates are no, I can't say this, whatever this hospital is. The NHS mortality rates are comparable or better than those in Britain, US. They boasted a 1.27 mortality rate and 1% infection rate compared to 1.2 and 1% in the United States. Man, there's a lot there, isn't there? You could really cover your entire medical tourism with those quotes. But do American consumers know about this? And do they care? If insurance is covering it, do they even care? So who would fix that? You think the insurance company would fix it, right? The insurance company would, hey, we'll pay you $5,000 if you go to Thailand, you get this surgery. Would that induce some people to say, yeah, vacation to Thailand? Maybe the person getting the surgery is not so great, but maybe you pay them $5,000, two family members can go. Thailand's a really gorgeous country. Might as well go for a vacation where your person gets operated for well, how much cheaper was it? You could do a trip to Thailand every year, couldn't you, for quite a while? I don't know how much. I must not have copied everything. Oh, I didn't get the first part of that, so it doesn't really make sense. So 32,000 versus 4,000, so there's 28,000 bucks. Kidney transplant, 150,000 versus 25. It was 125,000 bucks. You could go to Philippines once a year for the rest of your life for that. So yeah, I mean, they're powerful, powerful numbers. Does it make you want to? I mean, what would your family members think? Hey, let's see if we can get a vacation out of this. Oh, you need heart surgery? Just a second. We may well do this cheap. Would it make your family nervous if you're out shopping? I think I can get it a lot cheaper somewhere else. What do people hear when they say cheaper? Lower quality, right? What if you get it cheaper, $125,000 cheaper for the same quality? Would that make some sense? Would your family be like, well, what? Why are you shopping around? They may say, well, my insurance covers it either way. Why do I care? Here's one that you could look up. Smart Shopper gives workers a list of providers in the network and rates them on basis of quality. It then provides cash incentives to use lower cost providers. I don't know if Smart Shopper is still out there. This would be a good thing for you. I hope y'all are taking a bunch of these and give me a wide variety of these. MRI, 3,000 bucks, 1,500 bucks. It pays to shop for better care. Choose high quality, convenient. That sounds pretty good, doesn't it? That's what we need. But probably doesn't go international. It's probably just US only. But there you go. Smart Shopper. Could you use this with your family? Hey, let me go check Smart Shopper. What if you did this buying a car? Hey, there's this website that gives you, we can buy a car and save 80%. Would your family go for that? But then you go heart surgery. Hey, wait, I think we can save 80% on your heart surgery. That seems a little, they're like, yeah, I don't know. But if it was all coming out of pocket, you think they'd be more interested? 150,000 versus 25, you say, oh, that's going to cost you $150,000. I think I can get it for 25,000 with the same quality. Maybe it would, but without the data, with the insurance, you see all how it gets mixed up. Things that would be perfectly logical with any other purchase for some reason in healthcare. No, I don't want to do that. Yeah, so US is 40% of pharma revenues, but we're only 4 to 5% of the world population. So this is the argument that Trump and Biden both talked a lot about, that US is subsidizing the rest of the world on pharma, but we also get the drugs earlier. So, you know, it's kind of a debate. Here's another one on fraud. We lose about $1 trillion. They talked about that earlier. But that only occurs where there's insurance. There are no competitor stories of fraud. where people pay things directly. It's only when someone else is paying the freight. That would work really well under the fraud discussion in the first part of the problem section. Y'all see why I like this book? Really, really well researched. The Affordable Care Act, Obamacare prohibits insurance companies from charging six people. Okay. Can I ruin your Thanksgiving? You ready? So someone involved in the Affordable Care Act got in a lot of trouble for what do you call it when you picked up on the mic? An off the record mic. There's some word for that. A hot mic. So he said, man, if young people figure out why we're doing this, they're gonna storm the Capitol. And what was he talking about? Intensely overcharging young people to subsidize old people. Instead, what did they say? We need young people to buy insurance so that we can take care of. They need to have insurance. They talk about it as if they're doing you a favor, but he said, hey, if they find this out, they're going to be really upset. So they couldn't couch it like that, but he was caught on the. You can find that. If someone will find that quote, put it in your paper, you can. The Affordable Care Act prohibits insurance companies from charging sick people more, from denying coverage on the base of pre-existing conditions, and from charging older people more than 3 times as much. So they can charge your grandmother three times more than they charge you. How much should they charge your grandparent? 6 times more. So how can they undercharge your grandparents by 50%? Or overcharging you 300, 400, 500%. They can't overcharge you 100% because that wouldn't be enough, right? If your grandparents were paying 80,000 and you're paying 20,000, and they can only charge them 40, so there's 40,000 out. They're gonna have to charge you a lot to make for that difference. Now, obviously, there's a lot more to you, maybe than them. I don't know. That's kind of the question, right? You're seeing the growth in the retirements, but so the Affordable Care Act said you can't charge people more than 3 to 1, even though the right charge is 6 to 1. So they transfer risk. They transfer resources from low risk to high risk. Who's low risk? It's young people. It's you, right? So they're transferring wealth from you. Who's the wealthiest group in the United States right now? Senior citizens. So what are we doing? We're transferring wealth from whom to whom? From the poorest U.S. citizens to the wealthiest U.S. citizens. All right, bring that up at Thanksgiving and let me know how it goes. Rates for people 18 to 24 have increased 45% above their actually fair price. So the rate for those 60 to 64 can be reduced by 13%. How was mandating a price break on health insurance for this far higher income group at the expense of lower income group possibly fair? A health economist who helped Obamacare acknowledged that transparency about forced wealth transfers would have doomed the bill. You might look this guy up. See if you can find his actual quote. Well, here it is. I guess the quote's right here. I forgot I put it in there. If you have a law which makes it explicit that healthy people pay in and sick people get money, it would not have passed. Lack of transparency is huge political advantage, and basically call it the stupidity. This is the part, this is the part that got him in trouble. Call it the stupidity of American voter or whatever, but basically that was really, really critical for getting this thing passed. You can see why that was a hot mic. It's not exactly what you want the press, but essentially what he's saying is, hey, but not all the voters were stupid. The senior citizens were smart to vote for this. He's saying that you guys were stupid. Were you stupid or just not informed, or what was it? Who knows? But that's what he's saying. You were intentionally overcharged so that your grandparents would be intentionally undercharged. Now you might say, yeah, but when we get there, we'll be undercharged. But when you get there, we're going to be broke. So it's not going to be anybody to undercharge, to overcharge. So funnels resources from the less well-off to the more well-off. That's why Affordable Care Act by Obamacare had an individual mandate. So they had to force you to buy insurance. Why? Because you're being 45% overcharged with a tax penalty imposed on people. And then the Republicans, I think, eliminated the tax penalty. Cross subsidies are hard to maintain when people can avoid being overcharged for insurance by refusing to buy it. Now, remember when President Obama first did it, he said no mandate. We can't do mandate. But once he saw the solution, he's like, yeah, I have any choice. That's what made Hillary Clinton so upset, because she said, you have to have a mandate. President Obama in the debate said, no, you don't. And then as soon as he took office, he said, yeah, we'll have a mandate, because he saw the math. This system, you can't get this system to work if you allow young people to opt out, because you need to overcharge them to get the rest of the system to work. Yeah, that should make you mad. It should make you mad because that's just one of many examples of that going on. So this study did not find that people who cut back on medical treatments were less healthy than those who got everything the doctor ordered. To the contrary, it found that even though people who were treated for free used more medical treatments, their health was effectively the same as that people who paid more. That kind of gets you into the waste, I think, a little bit. People use the system just because they're not paying for it, but it doesn't make anything healthier. The system will treat you. If you walk into the system, they'll treat you whether you need it or not. You're going to walk into the system if it's free to you, because a third party is paying for it. It's a very, very broken system. Giving away healthcare for free has enormous downside. It encourages people to use treatments that are ineffective, harmful, and wasteful, and to rely on intensive medical treatments to cure what ails them instead of doing other things that would be cheaper and more efficacious. I love this word, but I can't say it. Someone say it for me.
Efficacious.
Efficacious, thank you. I could hear it, but I couldn't get it. Like exercising, diet, sleeping more, and cutting back on smoking. To make medical treatments free also diverts enormous amounts of money for other public priorities. Think about this. This is coming from Cato. That second article was someone far to the left. There are two extremes. You could put this paragraph in that second article and it wouldn't have stuck out. It would have been perfectly normal in there. They're both saying too much government, too much insurance. There's not enough consumerism. We don't have enough skin in the game. We're overusing the system. They're both saying the same thing. It's amazing. You can get agreement everywhere except for in Congress. It's really kind of freaky. The Republicans keep saying they want to overturn Obamacare, Affordable Care Act, but we don't know what they're going to replace it with. And, you know, they've had 20 years to work on it, and we still don't know what their solution is, because government just cannot come with a solution. Because as soon as you come with a solution, the other side is just going to destroy it with exaggerations. I mean, so really, this is a very, very difficult political issue to solve. When hundreds of millions, this could be a great last quote for your paper. This is the consumerism argument. When hundreds of millions of people spend their own money on healthcare, they will behave differently, and healthcare providers will too. So that's the consumerism final word. I love this book. If you're interested in healthcare at all, I spoke to Devin. He's one of our alums. He's working for United Healthcare. I've talked to actually two of our alums who work for United Healthcare. I'm going to have him speak to my class next semester for my security analysis class. It's called Portfolio Management, my security analysis class next semester. He's in this industry. I think he should be reading this kind of book. He's in an industry that's you know, United Health is a very complicated business, and it's gotten a lot of bad press for a lot of these type of issues. It's a complicated industry, but bottom line, you get back to their bottom line, government is messing it up, insurance is messing it up. That causes prices to be high because we're overusing this system. There's no incentive to improve quality, and no one knows what they're paying for anyway. The consumer doesn't know anything about prices, doesn't know anything about quality. The system has no incentive to reduce prices, improve quality. Why? Because the government and insurance distorts incentives. I mean, that's the bottom line. And really, this summary covers everything. All right, are y'all out of breath? Pretty complex. Anything in here that you didn't know before we started all of this, or did you already know all of this? Is any of this new? Nathan?
Well, my dad was complaining about dental insurance and dental bills, and I told him, you know, maybe we can go to Mexico and they have dental clinics there that cater to Americans. I don't know.
I have friends, there's an elderly couple, they both passed away, but they would make a trip to Mexico once a year and do medical stuff. I think they're buying pills or doing something, but yeah, she was fluent in Spanish. They went to northern Mexico. Y'all probably have relatives who do that, and they go across. I don't know exactly what they're doing. Dental's a little different because dental's like, I think some of the worst insurance there is because it doesn't cover the really big stuff. It only covers the really small stuff. So it's, you know, it's only covering low severity, high frequency stuff. But there are solutions. I do like, you know, seeing something like this. I don't know if it actually works, but seeing something like that someone is actually doing what should be the solution. Get consumers information on price and quality, give an incentive to be shoppers. That's what you want, but that's a small chunk of the system. Most people don't even think about it, right? They go close by, just assume all doctors are the same, do whatever the doctor tells them. So yeah, it's a strange system. All right. I won't show you an example paper tonight, but I will eventually. When this paper's due the Wednesday before Thanksgiving, right? You're a little late, that's okay. I will tell you though, don't be too late. And someone's got to be early. So there's 40 of you. I can grade about 5 papers a day. So the actuaries, that sound like 8 days to me. So I need 8 days. So Wednesday, Thursday, Friday, Saturday, Sunday, Monday, Tuesday, Wednesday. I may not have your grades back until the next Thursday. So I need more papers. I may be able to grade a few more than 5 a day just because, you know, we don't have school. But it takes me 30 minutes to grade papers. So maybe I can grade 4 hours a day. So maybe I can get it done in 5 days. We'll see. So try to get papers in on Wednesday. What's your biggest incentive for getting it done on Wednesday? You don't want to ruin your Thanksgiving, right? So get them in early. But I'll show you an example paper, but next week, I'll remind me if you don't see anything on Tuesday, so you can at least see one example. But what you're going to find on the example papers, most of them go almost exactly in the order of the rubric. And actually have titles by the rubric. That's the safest way so you don't leave something out. I've given you something pretty much throughout most of the rubric. I think I highlighted a few places where you need a little bit more. And see if we cover those. I think we didn't talk about pre-existing conditions, but that one's so the Affordable Care Act. So essentially, pre-existing conditions is if you cover pre-existing conditions, people only buy insurance when they need it. So you say, you know, I'm young, I'm healthy, and then suddenly you get diagnosis. I'm I'll go buy insurance now that I'm sick. And then you're covered. Well, you can't do that. So the insurance company says, yeah, we'll give you insurance, but you have a long waiting period. So we're not going to cover you for something. If you had a disease when you bought the insurance, that's not covered. How do we handle this? Well, employers handle it by having an open enrollment. So real important, insurance does not work if people can buy insurance only when they need it. What if you buy auto insurance after you've had an accident and have it covered? So, oh man, I just wrecked my car. I'm going to call up Allstate, get some auto insurance. It would never work, right? You never buy insurance until you need it. The price would be if your damages are $20,000, they're going to charge you $22,000 for the insurance. So you have to tell people you have to buy the insurance before you're diagnosed. Employers allow for pre-existing conditions if the insurance is purchased as part of an open enrollment period. Most of the insurance is paid by the employer, and the employment exists for other reasons than obtaining insurance. So you can go to USAA, start your job there. You can have a pre-existing condition when you start your job, and they'll cover you for that pre-existing condition as long as you sign up during that open enrollment. Why? Because USAA is paying for most of it. If the employers are paying for most of it, you still have an incentive. Only the health people would buy it, and the unhealthy wouldn't. But if USAA is paying for most of it, everybody's going to get it. It's an open enrollment period, which makes it awkward right? Because if you break your leg in February, can you wait 9 months? You know, before the open enrollment, say, I just want to get my leg fixed for 9 months. So it makes it awkward. So you have an incentive. And the employment exists for other reasons than buying insurance. So you cannot create an entity that its only purpose is for people to buy health insurance. Because then the only people that would join your association are unhealthy people. So people aren't getting jobs at USA because they're unhealthy. They need a job. Most of them are healthy. A few of them will not be. Has anyone ever joined USA solely to get health insurance in open enrollment? Yeah, probably that's happened. But that's a small percentage. So how does healthcare.org work? Needs to mandate everyone gets insurance to avoid this. Otherwise, if the government's going to provide health insurance, then people just say, hey, I won't buy it until I need it. When I need it, I'll go out and buy it. It doesn't work. You have to find somebody, you have to mandate it and have an open enrollment, which they do, right? We're walking into that period right now where you have that period of time you can buy the insurance. So what did Affordable Care Act do? Penalty for not buying health insurance. We won't get into that. The laws have changed. The Republicans have somewhat eliminated the penalty. President Obama campaigned against the penalty and then imposed the penalty after he saw that it really had to be there. The Republicans took it away. This is a tough one. Pre-existing conditions. I've heard a lot of impassioned speeches by politicians about how evil it is that health insurance doesn't cover pre-existing conditions. But insurance cannot cover pre-existing conditions unless you mandate that everybody has to get the coverage. And then you have SWEET. What does SWEET say? You remember how did SWEET get mandatory coverage for everybody? Anybody remember? 2 words. So my solution, the third thing in my solution. Tax credits. What do tax credits do? Everybody buys insurance. Why? Because if you don't buy it, you just threw away the tax credit. That's my solution so I realize tax credits is not part of a pre-existing conditions, but to me, it does solve that problem. Health insurance will work with pre-existing conditions if you cover everybody. If people get to choose whether they get the insurance or not, the unhealthy ones are going to choose it. The healthy ones won't choose it. The whole system breaks down. So there's a lot of discussion there that we've already had, but employers have already figured it out. The Affordable Care Act has been all over the place now. See if there's anything else. Yeah, there we talked about that one again today. That might be everything. We talked about this a little bit today. So maybe I should just I already forgot the name of that group. What was Smart Shopper? I don't know if that was essentially quality. I gave you some quotes from the last book. Smart Shopper supposedly gives information on quality. I didn't see it in that example, but supposedly information on quality. But there's some stuff in there on quality, so you'll find something. If not, I mean, it's pretty obvious if hospitals and doctors had to report quality, it would improve. I think I gave you one quote somewhere and you forgot to put it here. The experiments that they've done when hospitals have reported quality, their quality improved dramatically. When you force them to report it, they stop killing people and infecting people. It's pretty amazing. And then they fought that they shouldn't have to report it. So if you require hospitals to report, when hospitals report on quality, their quality improves immediately. It's pretty amazing. It's not shocking. It's exactly what you would expect. I gave you some quotes today when, people are just assuming, consumers should stop assuming price equals quality and decide based on data. They need to stop just assuming, hey, if that costs more, it must be better quality because there's no relationship there. So the book we just went through has some really, really good quotes on that. So you can fill that out pretty well. And then Michael Porter, we've covered that very, very well. And then other, have y'all picked your other yet? I'm kind of jealous. I actually want to go out and research everyone I talked about because they're all really, really interesting things. So, all right. So I'll show you an example paper next week, but get yours drafted this weekend, get it out of the way. You should have 70–80% of it already written just by what we've already done. I'm not putting this document out there. I wanted you to do your own. So, all right. Any final questions on the paper? Some final notes on health insurance industry. You have commercial insurers, which are becoming much, much more concentrated. You have Blue Cross Blue Shield, which is hard to really tell them apart from anybody else. They're all kind of merging together. Blue Cross was hospitals getting together to provide coverage. Blue Shield was doctors getting together to provide coverage. Many there's are converting to insurance companies anyway. Capitation providers like HMOs, PHOs. This is a fee for, they go with capitation, and you saw some discussion on capitation, is kind of a fee for a range of services. And the problem there is what hospitals and doctors were doing, just providing less service and less quality. So the quality of care was suffering. So you've got to focus on both the quality covered care and the costs. If you incentivize hospitals to treat, then they'll treat. If you incentivize them to not treat, they won't treat, and they'll harm patients. You've got to find some way. So you have one that encourages overconsumption, another one encourages limited supply. This one really worries me. I know some friends doing this in these self-insuring pools. Employers might do that. Military plans might do that. I know some individuals that are doing this. Some of them doing it through religious organizations. I think they're a little dangerous. They seem cheaper. They seem great. It only takes one really, really expensive case to wipe out the entire system. So I think they're really risking. I know some families have gotten together and do that kind of thing. I think it can be really, really dangerous. But there are different experiments out there. There's a lot of debate about private healthcare in the U.S. versus Canada. But the U.S. is much closer than Canada. Most people realize. If you combine Medicare, Medicaid, and Veterans Administration, it's the overwhelming majority of the costs. It's not the majority of the people covered, but it's the majority of the costs. We're getting to the point where we're pretty close to them. Most people are covered by one of those programs or by an employer-provided health insurance. And then we do have a group that are self-insured by choice. Most of them are young, healthy people who just think, I'll just roll the dice. I don't think that's a horribly bad decision, especially with the Affordable Care Act, because all you got to do is make it to November. And if you can make it in November, my approach, I think I told you my approach, I did USA's highest possible deductible. And it only took me 3 years, the savings and the premiums, to save up the deductible. So my insurance premium was so low that in 3 years, I had more money saved up than what the deductible was. And I figured there's a good chance I'm not going to need anything in 3 years. And sure enough, I went like 20 something years. So I don't think I'm not encouraging y'all not to have insurance, but I don't think it's the most disastrous decision. Now, if Affordable Care Act said, hey, if you don't buy insurance and you get a bad disease, you can never get insurance for that disease. You're stuck with it the rest of your life. You get some chronic disease that's $20,000, $50,000 a year. But that's not the way it is. You can come into the system, have a pre-existing condition covered, although you may have to wait a few months. Traditional medical expense, historically, were indemnity plans like your auto insurance. You just buy insurance like you buy auto insurance. You got a deductible. That was a lot of the insurance in the United States. And then people without insurance were usually treated by doctors overcharging their other customers. It was kind of the system actually worked fairly well back then. Today, the bulk of it is group insurance, employer provided or government provided. We'll talk about group insurance here a little bit later. Portability has been an issue with health insurance because employers providing the coverage. When you change jobs, you now have some risk. And so the Health Insurance Portability and Accountability Act, HIPAA, provides some protection when you change jobs, or even worse, that you're really, really sick and you're in a job you hate, but you can't change jobs because you need your health insurance. So HIPAA is protection for that. Affordable Care Act requires insurers to cover individuals' pre-existing conditions, but yeah, I'm not sure exactly. I mean, there's a lot of restrictions. You saw a lot of employers moving back to the indemnity approach and high deductible approach. I noticed this at USAA. 1 year, I went to the benefits committee. I was on the benefits committee because I don't own it, but I presented to it because I had their pension plan, 401k plan, post-retirement health plan. They spent the entire meeting talking about their health insurance coverage. And what they're talking about is, my word, why did we suddenly see all these claims increase? Everybody's going to the doctor all of a sudden. What did USAA do? They introduced an HMO. When you have an HMO, you pay $20 to go to the doctor. What were people going? They're taking their kids to the doctor when they knew there was nothing wrong with the kid. They can get aspirin. And they're like, my word, people are going to doctors 3 times more often than they did. So USAA switched back to an indemnity approach with high deductibles, and that's the last time they talked about it. It was like problem solved. So employers have silently been moving away from capitation back to more high deductible plans. And that's the reason I switched, because what you notice during those years is they really, really incentivize you to move to the high deductible. So your deductible maybe went from $1,000 to $5,000, but your premium may have dropped $3,000 or something. You're like, wow, I can pay for this deductible in a couple of years. You're really, really incentivized to move to high deductible. That's not so much the case today, but it was back then. I'm not going to talk about managed care, but that came in the 1970s. The thought process here was the reason health insurance is so expensive is you have all these specialists doing all these expensive surgeries. So what we're going to do is we're going to have a gatekeeper. We're going to have a primary care physician that you can't go to the specialist. You have to go to your primary care physician, and they'll decide if you can get that expensive surgery. And that was kind of the thought process. We'll cut the cost for you. You'll just pay a small fee to go to the doctor, but you have to go to the primary care physician. You can't go to the specialist. So that was a thought. At first, it looked like it was working. But what they discovered was that HMO plans were shifting all their costs to all the other plans. And so indemnity costs were going really, really high, not because they were getting more expensive, because HMOs were being incentivized. And then once HMOs blew up, the whole system blew up, and then firms went back to indemnity plans. So it's been a circus. I don't really care about PPOs, but you can just see that on the capitation side, you have HMOs, PPOs, there's some other ones out there, POSs. I would challenge you to know what you have, because they don't call them this anymore. You might have a capitation plan as one of your options. You may not know which of those that it is, and it can get really, really confusing. I think it's as a zoo. It really is. I don't know how many, I think some of you are employees, right? You have health insurance. Did you go through every single option you had in your plans? How long would it take? I did it for my pastor at my church. We went through every scenario. I went through every scenario. What if they have no healthcare costs? All right, here's the 4 plans. What if he has $1 million cost and she has nothing. All right, here's the scenarios. What if they both have $1 million cost? Here they are. I went through all of them. Looked at their pharmacy. I looked at their health coverage, their hospital, their deductibles. The spreadsheet took me forever to build.
A lot of companies now are getting a lot better at breaking it down in simple terms and comparing them side by side.
And it's
I've noticed that.
understandable.
Yeah.
Well, the key to me is the extremes, right? You got to say, what if I have no
And it
no
goes
claims.
extremes.
What if I have $1 million, what if 100,000? Because you need to know the million because some of these do have max coverage, right? So that's good. If they're doing that and it's understandable, you make decisions what you need to do. What I decided with the pastor, let's go to a high deductible plan and we'll give you an HSA. We'll pay everything. We'll give you an HSA. So essentially we say we'll break even. You end up with an extra $5,000. You do that for 2 years. If you have any health costs, then we'll pass some of the costs to you because you have to, that was the deal we made with them. And then he complained about his having to spend more. And it's like, you're not spending more. Quit saying that. They're gonna all hate me for setting up this process. It's, oh, this new healthcare plan. It's like, no, you have $10,000 sitting in your HSA that you didn't have before. He kept forgetting that piece. It's like, you're making me look really, really bad here. So, all right, that's it for healthcare. Complicated field. If you're an actuary, there are life insurance actuaries. Kind of a dangerous time to be a life insurance actuary right now because who knows what this is going to look like a few years from now. USAA had a full-time health actuary on staff. The guy looked stressed out more than anything, and it looked like a really tough job. They had a pension actuary and they had a health insurance actuary, and then they had an executive actuary because executive plans are really complicated. All of them are pretty dangerous right now because they're all very much driven by the tax law, and so tax law changes, those jobs could disappear. But they have the huge advantage of complexity. You get paid a lot of money, and this interesting thing, you know, think about health insurance actuary. This is an actuary not working, well, he was working for USAA, but he was an actuary not doing auto and homeowners insurance. So you can be an actuary working for a corporation that's not an insurance company. And that's kind of how complicated pension plans and health insurance are, that they actually need to hire an actuary to run these programs for the corporation. That's a pretty hefty expenditure to make for, you know, bring an actuary on full time to run these type of programs. All right, let's talk real quickly about some other insurance. Disability insurance and group insurance. Disability insurance provides you payments if you become injured or ill. So it's insurance to cover your pay. Most of it is group insurance. In fact, most of you will not be able to tell the difference between your disability insurance and your workers' comp. Most employers have combined those together. They're not really one coverage because workers' comp is regulated by the federal, well, some are regulated by the federal government, some are regulated by the state, so they have to be kept separate. So you might not know which is covering you because you don't really care. But what makes a difference in workers' comp and disability? Workers' comp is you get injured, you can't work, but you got injured on the job. Disability coverage covers you for if you're injured anywhere else besides on the job. It's the same insurance, but it's just how it's set up. Disability insurance is covered by the life insurance industry. Workers' comp is covered by the property and casualty industry. So that's kind of weird, right? They're in two different industries. For group insurance work, we already talked about that. The purpose of the group cannot be for insurance. It has to be for some other reason. And you need a large group. So 1 or 2 claims don't disrupt the entire thing. You might need disability income more likely than you will life insurance. And the interesting thing is, if someone dies, they lose their human capital, they lose their income, but they don't have any more expenses after their funeral. But if someone gets disabled, they lose their human capital, but they still have expenses to live. So it's a more expensive if it happens to you. So you have to keep paying for expenses for yourself. Social Security does provide some disability insurance, but it's extremely restrictive. We helped a woman at our church. I could not believe she could not get Social Security disability. There's no way she could work. There's just no way. She was very, very immobile, but she had to fight hard to get disability from Social Security. So it can be really, really tough. And Social Security is quite strict in definition. It is broken up between short-term and long-term. I don't think that's that important because you won't really notice it as an employee. You don't really notice when you switch. The big issue on disability insurance is moral hazard. Is people who just don't want to work, and so it can be moral hazard, it can be illegal, moral hazard. So people would rather not work than work. So one of the things you do is, first of all, make sure you don't give them too much disability. Disability insurance can be tax-free, so you definitely don't want to give them 100% of their pay because you're essentially giving their tax money back. You want to give them less than what they would have made take home, so they have some incentive to go back to work. There are certain groups that are better to insure than others, because there's some people who really hate their jobs more than other people. So you have to watch out for that. And you have to watch out for duplicate coverage. Absolutely, you're not going to be covered by workers' comp and disability at the same time. They're going to ask you, the first question they're going to ask you is, did you get injured on the job? Because if you got injured on a job, they're not covering you. That's going to go to workers' comp. So they're going to make sure you can't get double coverage. That's not true for life insurance. You can buy 20 policies on life insurance and they all will pay when you die. They may research why you died to make sure there wasn't something going on, but you can buy as many policies as you want. On disability, you can buy as many policies as you want, but only one of them is going to cover you. The others are going to give you your premium back and cancel the coverage. All right, I'm not going to cover the rest of this for the sake of time. You can read through that. It does matter what profession you're in. It does matter whether it's an accident or sickness. It's easier to defraud on sickness, so there's more restrictions on sickness than there is on accident. There are waiting periods. The waiting periods is kind of like the deductibles, so you have to be sick or injured for a certain amount of time, but that's usually not an issue, as most of y'all will have sick leave or some type of paid time off anyway that will cover that. So we won't get into these definitions, but this is the most important thing. If you're buying disability policies, read the definition of disability. If it says you're disabled, if you cannot work anywhere, that's the most restricted. So if you're a surgeon making $700,000 and you get injured, but you could work at McDonald's, you're not disabled. All right, that's not a very good definition. The best definition is you're a surgeon, you can no longer be a surgeon, you're disabled. That's the best definition. All right, so you got to read that. Social Security is on that very weak definition that you just cannot work anywhere. All right, we don't need the rest of this. I'm not going to show you these videos. They're hard to watch anyway, but there's plenty of, you can just go on YouTube and just do disability fraud or workers' comp fraud, and there's some pathetic videos of people pretending to be disabled who are not disabled. I'm not going to read this article, you can read it, but essentially the Economist was arguing we have something called the participation rate, which is the percentage of Americans that are in the workforce, and that rate has been dropping over the last decade or so, and it really dropped after COVID and hasn't recovered back. So I think it's down like 62%, and it's been in the high 60s. So it's like, where do all those people go? Some people say, well, it's all the baby boomers retiring, but that doesn't explain it. The Economist article, what it's arguing is there's a lot more people out on disability. And they're using disability as an excuse not to go back into workforce, whether that means we're classifying more people as disabled because maybe there's certain illnesses we're covering now that weren't covered before, or more people are faking or whatever. But they said it plans to 63%, but it's even lower than that now. So this article is arguing that it's the disability side that people are not working because they're now classified as disabled. So you can read the article. It's an interesting article. Long-term care insurance. This is the cover you for nursing home. It's important for baby boomers. Obviously, Social Security does cover some of this. I'm not really sure yet. I should figure it out. My mom's money runs out in about 8 years. And I think that's when Medicare will start covering her. I don't know exactly how much it's going to be. We're going to cover, don't worry, we're not going to let her go out in the streets. She's going to be taken care of no matter what. But if Medicare is gonna pay for it, I know I've said we're ripping young people off. I'm gonna continue that ripping you off if it's gonna cover her, because she's paid into Medicare, even though it may be a fraction of what she should have paid in. And we'll definitely see what Medicare will cover. So I'm gonna be learning a lot about that if she outlives her money. But long-term care is a policy you can buy. You'd usually start buying it maybe in your 40s or 50s. You can't wait and buy it when you're 70. You got to buy it earlier. The problem is you got to really worry about the quality of the company you're buying this from. There are, maybe I can show you one. It's probably the most famous firm. Well, what's the most famous firm for disability insurance? You probably love their commercials. Yeah, it's an animal in the commercial that helps you. Affleck, right? I love the commercials. The only problem is at the end of the commercial, you ask, what do they sell? And most people are like, oh, I don't know. Y'all know Affleck sells disability insurance. Next commercial, watch, and you'll see that it's disability insurance. But you all know the commercial, right? So great commercial, but you don't know what they sell. Why is it? Because they're probably selling to employers. But here's Genworth. Genworth sells long-term disability insurance. Their stock was $36. It fell down to $1.70. It's back up to $9. Is this a firm you want to put 30 years of faith into? So almost went out of business. Come back some. One of my students, I showed them this because I called a friend of mine. Said, is Genworth really being destroyed by the financial crisis? No, we have no idea why the stock fell. So he went out and he bought the stock, a bunch of it, and he was really happy after he did it because he sold it somewhere in there. But yeah, USAA had a contract with Genworth to sell disability long-term care. And I mentioned to my boss because he was in charge of it. I said, you realize their stock has fallen like 97%. And should we be worried about that we're selling this product to our customers through a company whose stock price just fell 97%? So I like making my boss really, really nervous. He's kind of jumped there. So it's tough. I won't get into what you're covered, but again, the definition of when you're covered is really, really important in these policies. Here's an article on it that you can read. I'm going to jump ahead so I don't get too far behind in the class. Genetic testing is extremely important because they can now predict who's going to have Alzheimer's pretty accurately. Who can use that testing? There's laws important in Congress to limit insurance companies using these type of tests. But it's interesting because what's the problem if you can get the test, but the insurance company can ask you who's going to buy the coverage? Only people who need it. Insurance can't work if only people who get Alzheimer's are going to buy long-term care. So, someone's going to have to figure that out. But there's a lot of that testing. It's still pretty expensive testing. All right, we'll start here and we'll finish up all these other products and then bring your calculators on Thursday because we'll definitely be covering pricing on Thursday. Let's finish up these products. It feels like we're a week and a half behind, but this means we have less time for accounting, which is not my favorite topic. I did have one class set aside to do some work on the second paper, but we'll see. We may not need to get to that class, so I think we can get somewhat caught up. I did want to cover this. This is very, very important. This might be an issue comes up with your family. There's something called life insurance accelerated benefits. This is what you get from your insurance company. What this means is someone has life insurance and they've got some horrible disease. They're probably not going to live much more than a few months. They really need the money for their health care. So what the insurance company says is, okay, well, go ahead. We know you're not going to live much longer. Well, go ahead and pay your life insurance now. Obviously, that means the money doesn't go through their beneficiaries, but their beneficiaries are saying, well, they own the life. The person who owns the life policy has the right to, change the beneficiaries. They're essentially making themselves the beneficiaries instead of the beneficiary. Easy for older people, maybe have nursing home bills or other medical bills. And it's just like, if you don't let us get this life, it's going to come in anyway. we're gonna either burden our family now or we get the money now and they'll get less later. But either way, they're about the same. This is not the only thing to do though. Let me just make it really, really important. This concept here of a viatical company, how many of you have ever heard that term before? Viatical, does that sound familiar? So I went through this with a relative. A viatical is not your insurance company, it's an entirely different company. But what they will do is they will buy life insurance policies from people and they'll pay the premium. And that's a way to get your money early if you can't get it through an accelerated benefit. So remember, the accelerated benefit is from your life insurance company, but this is from a separate company. So just to give you a good example with my situation, we had a policy with a face value of essentially zero. This was that universal life policy that interest rates weren't high enough to keep the policy in force, even with them paying the premium. And so if we had surrendered the policy, we would have gotten nothing. But the person whose life was insured was really, really sick. So we had this is the policy I was talking about where the premium from $250 to like $2,000 or something crazy just overnight. So you have this horrible situation. You have this person who's really sick. They might live 3 or 4 more years, but they're likely to die within 6 months. If you let the policy just cancel, you get nothing. If you keep paying the premiums, $2,000 a month, and the person lives 3 years, then what do? So I went to a viatical, and the policy face was say $140,000. They offered me $50,000. So you have a couple of choices. One is you just stop paying the premiums and policy lapses. What do you get then? You get zero. The second option, you keep paying the premiums, $24,000 a year. And the person doesn't die, you're in a lot of trouble. If the person dies, you get the $140,000. Or you sell it to another insurance company. Which of those 3 choices would you never do? Surrender it for zero, keep paying the premiums, or sell it to a viatical? Which one of those 3 would you never do? Surrender for zero. All right. So if you don't have an accelerated benefit, you don't qualify, never surrender the policy for zero if the person's over 65. Always go to the viatical and get a quote. I will warn you, they're a lot like Lending Tree. If once you contact them, they will contact you every 3 months for the rest of your life until the person dies. They're pretty aggressive. How do you find one? It's really simple. You just type viatical companies and they're all out there. Here they are. They even have a calculator. I don't know if you saw that. And you can put that in there. You use a calculator, you probably have to give them information so that they can email you. And not even email me. One vital company, this guy was calling me once a month. It's the same guy. I recognize his voice. It was my situation was a really bizarre situation. So I was kind of putting him off. But he did offer, they said they would give us $50,000. Definitely better than that. Then my choice is, do I take $50,000 now or do I keep paying the premium? And when the person dies, I get $140,000, but I'm going to be out $2,000 a month. What I finally did was that choice. This was on a family member. My mom was paying the premium. I told my mom, I'll pay the premium. And if the person doesn't die, then I'm just out the money. If the person dies, you reimburse me from the life insurance premiums and then you keep everything else. So that's what we did. And the person passed away about 8 months later. So it cost me $16,000, but my mom got $124,000. I got my $16,000 back. But the viatical was on my list because the person we were insuring had been sick like this many times before and kept recovering. Or like, now he's in his 90s. So yeah, maybe this time maybe he won't recover, but the viatical. So viatical is not your first choice to eliminate is surrender for zero. Never do that. Now, for the viatical to work, the person's got to be pretty aged. You're not going to do that on someone who's in their 20s or 30s. They got to be in their 60s or 70s, unless they just have some obvious illness. But in that case, you'll probably just keep paying the policy because the premiums would be pretty low. All right, so don't forget the Vidical. It's out there. It is an option. Insurance companies, they hate these firms. What happens with the Vidical? They buy the policy from you and they start making the premium payments. And then the person passes away, they get the proceeds. So they actually keep the policy, and obviously they're going to want to keep the policy in force because they just paid you $50,000 for it. They have actuaries working for them, and they're probably going to pay you an amount that's less than what you should get from an actuarial standpoint, but it's better than what you can get anywhere else. So, you know, you at least give them a shot at it. So that's the Vidical. So there's the company itself, and then there's Vidical companies. Group insurance, I don't want to spend a whole lot of time on group insurance. Most of you will buy your health insurance or your maybe some life insurance through a group policy. So your employer might offer you one time your pay as a policy for free. You don't pay anything for it. It's a group policy, so you don't really own the policy. Your company does. Almost all group life is term insurance. It's really not permanent insurance. The face amount tends to be lower for group policies. There is a group contract that the employer signs, the master contract. Supposedly you as an employee get some kind of certificate, but I don't really know what that is. It's probably an email of some kind. They don't look at your health, they look at the group, and they get the sense of the group and their health. I don't know if I told y'all this story before, but I was having to work this with our life insurance company insured USA's employees. So they needed data on gender and age of all of our employees. They also needed income because we covered one times income. So I needed that file. I was assuming that file would be, you know, pretty touchy. You don't want to send a file out with people's incomes, their salaries. But the person at HR sent it to me with names, including the CEO of the company. So that was interesting. I saw it and didn't look at it. I know y'all don't believe me, but I didn't look at it. I have no idea what this. I looked at it, saw his name, clicked off, and said, "Why in the world do you send this file out? It's not on my email. I could have sent it to the world if I wanted to. I could have sent it out to the entire." But so that freaked me out. I thought they might send it with, you know, maybe Social Security numbers or something. But even then, you don't put the CEO on. It's obvious the CEO is going to be the top number, but they sent it. So, but you do need, you need gender and age. You need those two things because you're going to rate these. But then if you're paying one-time salary, you also need their salary in order to increase it. Now, USA had a problem where they had a separate policy for the executives. And we had several executives who had some serious health problems. So we were really worried this policy was going to really lose the life insurance company money. One of the execs that we were worried about was one of the execs who had cancer. She's a really good friend of mine, and she's still alive today, and that was 30 years ago. So she survived the cancer and is still going strong today. So, but they were worried about her because executives' pay is so much higher. You know, each person's, you know, a few $1 million. So it can be a tough policy to control. So at USA, they look at the execs separately from the rank and file employees because of the massive amount of pay to the execs. They're underwritten at the group level. So they don't look at the individual employee's health. They don't do blood tests. They don't do anything like that. They look at the entire group. They look at why the group exists to make sure there's not going to be some anti-selection. And they want a stable group more for administrative costs because you can't be constantly bringing people in and out and keeping track of all these records. How are the benefits determined? Some formula based on years of service or your salary or something along those lines. And then who's eligible? It might just be full-time employees, might be certain rank, who knows. The premiums can be contributory or non-contributory. Most are non-contributory, which means the employee doesn't pay anything. It's only the company pays. The life insurance company prefers that because then there's really no anti-selection. If the employees pay anything, then they're going to say, well, we're going to need at least 75% of the employees participate, just to make sure that the only ones getting the insurance aren't just as sick as people because they have to pay the premium. The employer may take on some of the administrative burden, keeps the premiums lower. They might look at the experience of this particular employer. Depends on how large the employer is. And of course, they got to look at the composition of the group. And what industry then they are in. There are some industries that are more dangerous than others. I'm not going to go through the contract. Y'all don't need to know all these, but there's a bunch of formulas. Don't forget that you're getting this as a benefit. It's actually pretty important. One time's pay is a significant amount of money. For someone who's single, no kids, that may be all the life insurance you need. So don't forget that you have it, that can handle a lot of things, you know, for taking care of funerals and those kind of things. So if you don't really have dependents, your employer may be taking care of everything they need. But then also remember, if you change jobs, that you just lost that insurance. And so you might need to buy insurance when you change jobs. All right, these other stuff you can just read through, not that critical. You can convert some of these policies, but very few people do, because employees that leave a company convert this to a permanent policy. They tend to convert because they're really, really sick and they're probably going to die, and because these usually aren't very good. So they're priced horribly because usually the payouts are going to be pretty high. All right, so don't forget, you get this as one of your benefits, probably more than likely, and your health insurance is probably going to be group policy. Some other interesting policies, key life insurance. If you got a founder, or maybe it's a partnership. If one of them dies, it dissolves the partnership, those kind of things. Then you have a policy that if one person dies, it pays a large enough life insurance that the firm can keep operating. Really good for partnerships. It's a good way to kind of make sure that transition works. COLI, BOLI, TOLI. I got involved in this at USAA. COLI is corporate-owned life insurance. BOLI is bank-owned life insurance. And TOLI is trust-owned life insurance. I've never done COLI, but USAA sold BOLI. And then I had a trust where we looked at TOLI. So we're on the product side, and then I was looking at it from the customer side. COLI looks a lot like BOLI. So bank-owned life insurance, it sounds sinister, but in a company like a bank buys insurance on its employees, and if its employees die, the bank gets the proceeds. And that just sounds horrible, doesn't it? It's like your bank's hoping you drop dead so they can get $100,000. When you see something that just doesn't make sense, what's probably driving it? You can see it down there in the notes. It's always the IRS. So what firms are doing is they're buying this life insurance, because remember, life insurance is tax-free when you get it. So essentially what they're doing is like an investment whose return is tax-free. That's the way they look at it. And so USA sold a lot of this from its life insurance company. And then Bob Davis, the CEO, heard about it. And he said, we're not going to do that anymore. And the actuary running was like, that's stupid, because they're making a lot of money off of it. He loved it. He thought it was great. Bob Davis said, but it's not going to our customers. It's not going to our membership. It's going to banks that we don't care about. So why are we doing that? So they got shut down. That actuary was not happy about that. But that was the actuary I went to when someone offered me TOLI. So I had some of our insurance trusts for our employees, and someone came to me with a TOLI policy, and I looked at it, and it made perfect sense. I did the net present value. It made a lot of sense to do it. And then I went to the actuary doing BOLI, and he looked at it and said, there's no way your employees are going to die that fast. They're using a mortality table where people die a lot faster than they actually die. So when you do your cost benefit analysis, you're assuming you're going to get all these proceeds, but you're not going to get them nearly that fast. He convinced me it was not a good deal. So I'm convinced now that people buying this are getting ripped off. So if you're in a firm that's looking at COLI or BOLI, you might say, remember in their health insurance for your ENT says they want to do surgery, that you need to go get a second opinion. If someone offers you COLI or TOLI or BOLI, go find an actuary who's independent to look at that life insurance payout and ask, will people really die this fast? Because that's going to time your cash flows. But it is tax driven. That's the main reason they do it. The IRS has questioned this to say, what in the world, where is the insurable interest? And companies argue, well, you know, if our employees die, that harms the firm. We have to get new training. We will need some money. So they kind of argue that the IRS is throwing in the towel and has continued to allow these. I don't think the IRS really likes this. I think they just had political pressure to accept it. But it's interesting. You might see some of this. Your firm may be doing this. Some of them may actually sweeten the pot a little bit by offering you $5,000 of life insurance for free. So they're buying $150,000 in your life, and then they throw in, hey, I'll give you 5,000 of it. So you're not going to, you know, you don't care. You're not going to turn down free insurance. And that kind of gets you to be okay with the whole thing. But I'm convinced it's a ripoff, but who knows? I trust that actuary. And he knew what he's talking about, right? He's over there salivating over selling Boley because he knows he's making a fortune. And then I'm buying that same product on the Totally side. So it makes some sense. All right. There's all the products for life insurance. I had some students interviewing for a job at Blackstone, which was providing products to the life insurance industry, and they wish they'd taken this class because it really would have helped them, especially these next few sections. It is a very complex. I think life insurance, these products are far more complex than banking products or property and casualty products. It makes it a really tough industry. Some of them are really good products. Some of them are really unethical. It's an interesting industry, to be sure. But the fun part is the math. So you're ready for some calculators, especially actuaries. This won't be advanced as actuaries will see, but what actuaries see is this, just more formulas. So I'm going to show you the formulas we're going to use. Actuaries use some simplification formulas that include, kind of combine a lot of things together in a more complicated formula, but it makes the calculations faster. So pricing insurance, how do you set a price for insurance? So you were taught in your economics class that price should equal marginal cost, including the cost of capital. That should be the same thing for insurance. You should set a price that you get exactly your return on capital that you're required to get. If it's really competition, there shouldn't be excess profits. Should make exactly your return on capital. So that's what insurance should be. Also, what will the market bear? You look at elasticity. I don't know if y'all had that. USA did elasticity studies on this auto insurance. What happens if we increase our rates 10%? How many customers will we lose, kind of thing. So, you know, you want to see what the market will bear. What are the competition? The buyer's ability to pay. In life insurance, this is the thing that's the most surprising, is most people when they buy life insurance don't shop around. And it's a huge mistake not to shop around. You should, well, I would always include USAA. I'm not saying that because you used to work there. I'm saying that because I know how they price their policies. They intentionally made sure they were in the top. And so if someone's better than USAA, you know you're getting a good deal. You may not get the best deal, but that's pretty good when you're looking, you know, you don't have time to look at 3,000 companies, do you? So if you can find a better deal than USAA, then you know you got a good deal. So USAA is a good competitor. State Farm, MetLife, Prudential, they all have, on the life insurance side, they have good products as long as it's what? Term or whole life. Those products you can easily compare. So definitely make sure, if you hear people talking about buying life insurance, first thing you should say, well, first of all, do you understand the policy? Is it level term or is it whole life? Then that's fine. Anything else, you probably don't want to touch it. Secondly, did you look at least 5 companies to do a comparison with? Most companies do quotes online. They won't sell it to you online with life insurance, but they will do quotes online, and those quotes probably are what you will get, and you can use those to compare. USAA will give me a quote on life insurance online. They'll call me. USA last week, very irritating. I'll tell you all this. They had an AI robot call me. Really irritating. He was nice, he or it, whatever robot is, but it was nice enough when I said, I'm not interested. It's okay, thank you very much. He didn't like keep pushing, but not a good experience. So USA is experimenting with that, and that I don't think USA customers are going to like that at all. Because they didn't tell me it was a robot. Doesn't that bother you if you know you're talking to a robot and they don't tell you it's a computer? It's just when it's making itself try to sound like it's real. It was too friendly not to be a robot. All right, so for you to get your price, you got to know what the cost of goods sold is and what margin you need. Insurance is different. Most companies know their cost of goods sold when they're selling the product, because they have to build it at the bottom raw materials. Cost of insurance for insurance, you don't know until many years later. You set the policy now, but you don't know what your claim is going to be. So you're doing some forecasting. It creates risk. So it increases the risk, so you have to have a higher return. That's got to be equal to or higher than your cost of capital. Capital for insurance companies usually includes debt and equity, all their funding sources. I'm not going to cover Miller Modigliani, but hopefully, have y'all had this? How many of you remember Miller Modigliani here? If you're a finance major, you don't know Miller Modigliani, guess what you need to do? You need to go put Wikipedia Miller Modigliani. I'm sure you've heard of it. Jonathan, you've heard of it, right? I won't put him on the spot, but if you've heard of it, can you explain it? And if I gave you an image, well, if I can find one. Does that look familiar? No. Ah, where'd it go? Yeah, you really should know this. It's actually pretty important. So what Miller Modigliani, have you ever even heard of him? Okay, so this is a question I would ask in interviews just to see if the college is covering the right kind of stuff. So you should have this. So what they're asking is, does the value of the firm change if they use less equity and more debt? What happens to the value of the firm as they add debt to the cost structure? Is that coming back to you at all? A little bit. VU is the value without debt. VL is what? Value of the firm levered. And what they show here is as you use more debt, the value of the firm goes up. Now, how would you get this wrong in an interview? You would say, oh, that's because debt is cheaper than equity. My cost of equity is 8%, my cost of debt is 4%. But that's the wrong answer. What's the right answer? What's the only reason why the value of the firm goes up as you use more debt? What's the difference between debt and equity when it comes to the IRS?
Interest,
Huh?
interest payments,
Yeah, so what about interest payments?
tax deductible.
Tax deductible. What about dividend payments? Not so. The only reason the value goes up is the tax shield of debt. All right, so y'all should know that. Really, really important. Why does the line start coming down here? Because the risk of what?
Default.
Bankruptcy. Yeah, default risk. So there comes a point where you use too much debt and the firm can't hire employees. They can't get contracts. They can't do things because everybody's so worried about them going under, they just can't function. And so there's some optimal level of debts that you maximize the value of the firm. Now, I've always thought of that as a theoretical number, but if you listen to the videos by Demodrin and New York Stern, he actually does a mathematical equation where he tries to find that actual spot. He uses time into CERN, which I don't really think works, but that's what he says he uses. So there's that one model, or you can do it like this, where you don't put the value of the firm on the side, you put the cost of capital. And the firm is maximized where the cost of capital is minimized, where your tax shield minimizes. So there's Miller Modigliani. That's when we're normally talking about capital and cost of capital, those kind of things. You usually bring in Miller Modigliani. You should know that, have some background for insurance companies and banks. Capital, they use the word capital a little differently. So if you walk into Walmart and say capital, they're going to think debt and equity. Insurance companies, when you use the word capital, they normally just mean net worth internal to the firm. Outside of the firm, they'll mean debt and equity, but inside the firm, they usually just mean net worth. And that's mainly because insurance companies usually don't borrow money. Most of their liabilities are their customers. And so the capital, they look at the net worth of the firm as a cushion against risk. So the more risky you are, the more net worth you need, the higher return on capital you need. So risky products become really expensive because you have to make more money and you have to hold more net worth. For life insurance, term insurance is the most risky because remember, they don't have that face value, the policy, kind of backing the policy. So it's the riskiest. Whole life is the least riskiest because you have all that face value there. Annuities are very risky, but we'll talk about that later. That has to do with interest rates. Interest rate risk. So if you're an actuary, there's a department in insurance companies called the Asset Liability Management Department. Usually has one actuary who spends 98% of their time sitting on a computer running models, a lot of Python, a lot of SAS, SQL, and all that kind of stuff. Pretty intense department. They're usually running a lot of stochastic models, running what happens if interest rates rise, what if more people die. I was amazed in my career, about 3-4 years of my career, I worked a lot with the life insurance actuaries. I was amazed at the data they had. It's pretty, they were doing things in the 70s and 80s that you wouldn't have thought would have been profitable. But very advanced on computers, very advanced with programming. I've heard banks and property casualty companies talk about doing this really advanced analysis, and I always think, yeah, but life side's been doing that for 20 years. It's not all that modern. So this would be the ideal job for a life actuary, but there's not many of them. So your chances of getting in there is going to be pretty low, but it's great. The nice thing about this job is it's both heavy actuary and heavy investments. The actuaries in these departments know fixed income securities better than investment people do. They're just incredible experts on the investment side. So it's a great job. It pays really, really well, but there aren't many of them. And if they mess up, the whole firm goes insolvent. So they're kind of important. Our cost of goods sold is going to come from the mortality table. So let me show you the mortality table we're using. We're not using an up-to-date one. We're using the 1980 table. Why? Because I want to keep it simple. The more recent tables have gotten really complicated. I like this table. It's just really, really easy to use. I might show y'all here. I can't remember what I put out there on our class. I might have given y'all a little bit more information. No, I might add it out there. I've had some articles. Let's see what the latest CSO life table available. Oh, they got a 2025. So I'm what, 45 years behind? Your parents were born after the table we're using, but it's not because I don't want to change up. It's just the newer tables are really quite complicated. So there is a very, very recent one. They don't update them every year. They need a lot of census data and other things. So I don't know who ESC is. But you can get these tables. One thing to be, here's one from the Social Security side. I don't know when they updated this, 2022. So a little bit different looking table, but you can find this stuff out there. When I was at UTSA, a new table came out and people were dying much less frequently. And so life insurance premiums dropped really fast, like 25-30%, just immediately. And UTSA loved it because they could sell a lot more policies. The other thing to be careful of, this is the CSO table. This is a statutory table. This is what the regulators require. People don't die this fast. All right, it's conservative. So life insurance companies do not have to use this table. They can use their own data and assume people die more slowly and they actually cut their rates even more. But this is the table you have to use for setting reserves and doing some other accounting. So it's a pretty conservative table. I started at age 25. It actually starts at birth, but I didn't want to get that complicated. And It did show, I think, 10 million lives, and I didn't want y'all to have to use such massive numbers on the exam. So I went to 100,000 lives just to keep it simple. So what it says is you start at age 25 with 100,000 people. And then what happens at age 100? How many are alive at age 100? You start with 111 die, 100% mortality. All right. Tables today, that's what I want to show you. Tables today go out to 125. That doesn't mean you still got people at 125. Most of them, everybody's dead by 115, but they go out that far. This table only goes out to 100, so that's another advantage. Keeps it a little simple. The other thing you have on this table is it will be male or female. Why is that? Because men die earlier. This is a male table. And what do you notice about the male table? Mortality increases except for when? Increases. Y'all notice anytime it declined? The first 4 years. I think we talked about that. Why does it decline the first 4 years? You mentioned in the previous class. What do men do in their 20s that makes them die faster? Driving, yeah. This is the auto side, and then suddenly they start driving, and I've seen that with, yeah, I know men I would not have ridden the car with in their 20s, and then 20 years later they got a wife and kids and they drive like, yeah, it's completely different people. So I don't think the female table, it maybe does that a little bit, but it's not nearly as drastic as that. The other thing we have is you have smoking and non-smoking tables. This is a non-smoking table. How material is smoking? Really material. So that one, you really notice that one. There are other tables that they do. I don't have those, but we have, I forgot the word, I have to find it. Oh, select and ultimate. Select means it's the mortality table for someone who just saw the doctor recently. Ultimate is the mortality table for someone who hasn't seen a doctor in a while, right? This is an ultimate table. We don't know when person's seen the doctor. So you see how precise insurance companies get. They have other things that they look at besides that, but those are the main ones. Are they male or female? Do they smoke or not smoke? Have they been to the doctor recently? Once you have those three, you can get the right table and look through it. So let's look at this table. So we have age. The actual term is attained age. I haven't found an actuary yet that can explain to me the difference between attained age and age. So I assume whatever age you are, you've attained it. But they use that term attained age. You have L sub X. What do you think L sub X is? This is actually really, really critical. L stands for what? Livers. So L sub X is what? Is it percent, number? What is it? Number of people alive when? Beginning, that's really important, beginning of the year. Make sure you got that. You're going to see on the math problems, extremely important. The livers, that is at the beginning of the year. That's L sub X. So L25 is 100,000. L29 is 99,311. Okay, that's L sub X. What do you think P sub X is? It's the number of L sub X's alive at the end of the year. So P sub X is the percentage of the L sub X's who live one more year. D sub X, what do you think that is? Number of people what? Dying when? What does the mortality table assume? So this is real important. It makes it really easy for you. at the end of the year. Exactly at the end. So we assume if they're alive at the beginning of 25th, if they die, they would die exactly 1 second before their next birthday. They live all the way through the year. Now, obviously, they're going to die throughout the year, but the regulatory tables assume you die at the end of the year, and then you make other adjustments around the table to adjust for that. We're going to keep it simple and assume they do die exactly at the end of the year. You're going to see that's really, really important because when do people pay their premiums? Beginning of the year, end of the year. Beginning of the year. So the livers are times 0. The dyers are a year in the future. As you keep that separate, some of the more complicated problems are not that complicated. And I'll show you, on the exam, some of y'all be using your fingers, which is fine, but I'm going to give you a trick when you get through those problems. And I'm talking about livers at the beginning of the year. You subtract. I'm talking about dyers. You subtract and add 1, and we'll see how you do that. So you make sure you always have your M and your discount rate exactly right. And then the Q sub X, so P sub X is percentage that live. The Q sub X is the number that died. Do y'all remember from your article, human capital article, remember the Q sub X was in there in that formula? If you can remember back to far, if you go back and look at the article 1 or paper 1, the insurance mortality was a Q sub X. That was what's in the formula. So I don't know how they picked the Q. I don't know why they picked Q and P. That seems kind of confusing, but I guess one's going forward and surviving, one's backed up against the wall and about to pass out. So I don't know how they figured that out. So L sub X is the number of people alive at the beginning of the year. D sub X is the number of people, not a percent, number of people dying at the end of the year. P sub X is the percentage that live that year. Q sub X is the percentage that died that year. We can actually use more than 1 year. We can say how many 25-year-olds will still be alive at age 30. So that would be 5P25. We'll talk about that. So the X is always the age. We can put a number before the P and before the Q, but P25 would be the percentage of 25-year-olds that will make it through the next birthday. 5P25 would be the number of 25-year-olds who will still be alive at age 30. All right, so we can't put another name. You can't put a number before the L or the D, but you can put a number before the P and the Q. All right, and it just goes down, people dying, and then at the very end, we stop it at age 100. So we'll be using this table quite a bit. You're going to see on the exam, there's 3 problems. You have to actually calculate the premium, maybe a little bit more than that, maybe 3 or 4 or 5 problems. You have to actually calculate the premium. There's several of them where you don't calculate the premium, you just write the formula. So I want to see that you can do the formula, and then there's one formula that's massive. You'll see, we'll just have to get practice on that. Most students actually do pretty well. Some of them get the wrong answer, but they did everything right. It's just that there's so many calculations. There's a lot of math errors, and I'm like, I'm fine with that. I'll give you full credit. You set it up correctly. So I don't want you doing that every problem. It's kind of silly for you to be calculating these massive formulas 10, 20 times, but I do want you to set up a problem. But bottom line, it's a present value problem. And the premium the insurance company is going to charge needs to equal the present value of the death benefits plus the present value of the expenses plus something for profit. The only thing we're going to price in this class on the exam is this first one. We're just going to do the present value death benefits. That's known as the net premium. So we're only going to calculate the net premium. Anybody remember from my P&C class what the P&C side calls the net premium? I bet y'all won. It's been too long. Nathan, I can't remember which size Nathan who was in that class. Nathan, it's been a while, yeah. Do you remember the pure premium? We talked about the pure premium. So on the P&C side, they call it the pure premium. That's the premium that just covers claims. So life insurance side, they call it the net premium. But all it is the present value. So if you know how to do present value, you just got to throw a mortality table on top of it and you're done. Right? Pretty simple. But you got to remember, people pay their premiums at the beginning of the year and we pay death benefits at the end of the year. So you're always going to that one year difference. Okay. Required profit is what required on redeemed on capital, and then required capital is how much net worth you need, usually defined either by the rating agencies or the regulators. We'll talk a little bit more about that. So regulatory or rating agencies are management. So the gross premium is what you're actually charged as a customer, and that's the net premium that covers the death benefits plus the loading. The loading is the expenses and the profit. So to do a present value, you need a discount rate. We're not going to get into that discussion. I'm just going to give you a discount rate. We're actually going to use the expected return on the investment portfolio as our discount rate. And so in this class, we're only going to price the net premium, mainly because these other parts are not all that complicated to do the math, but it's complicated to get the numbers. And so I just want to spend time on that. All right, so we already talked about this, LX, DX, QX, PX, y'all got those down. NPX is the N is the number of years. So X is always age. Make sure you have that down. X is always age. N is number of years. So NPX is the number of years someone age X. The probability that someone age X will live in more years. Okay. In QX is the probability someone age X will live in more years. NPX plus NQX should equal what? Better equal what, right? Is there a third option? I guess if you're Elisha and you go up in a chariot or something, or Elijah, but we're going to assume most people are going to either die or live. I used to, on the exams, you'll be really, really happy, but I used to have an entry section where I had you had to deal with the symbols, and the percentage on that part of the exam was like 40%. So I just stopped doing it. It'd be nice if you're an actuary, you probably should get comfortable using these symbols, but I'm just not gonna mess with it anymore. But you should know how to do this. So LX plus 1 is actually a smaller number than LX. The number of people alive at age 25 is a larger number than people alive at age 26. Because L26 is going to equal L25 minus D25. All right. So when you see that LX plus 1, remember that's a smaller number than LX because there's fewer people alive as you get older. DX equals the number of people alive times QX. That's that mortality that was in paper 1, article 1. You can do the algebra. QX is DX divided by LX. PX, this is actually a pretty useful formula. PX is LX plus 1 over LX, or L26 divided by L25. NPX is actually LX plus N over LX. So if you want to know how many 25-year-olds will be alive at age 30, you just do L30 over L25. You can actually see that in the mortality table. It's pretty straightforward. How many 25-year-olds will still be alive at age 30? It's going to be 99.141%. 99,141 divided by 100,000. It's pretty straightforward. So how many of them died? Well, 1 minus 99,144, 41 over 100,000. Right? And you can't just add these to get how many died, because each one of these is being divided by a different L. All right, so you can't say, so we can say the number that live is 99,000 over 100,000. That's NPQ, but you can't get NQ 25 by adding these numbers together, because this one's divided by 100,000, this by 99,000, this by 99, 650. So you'd have to actually take 1 minus 99,000 divided by 100,000 to get the number of people dying. You'll see which one of these we use in the exam questions. So 6p45 is the probability that a person age 45, so always remember X is age 45 will live another 6 years. The 6 is the end to the age of 51, or that would just be L51 divided by L45. Q25, probability of a 25-year-old will make it to 50. What do y'all think that is? Let's see how good y'all are at actuaries. I'll tell you that. What's the probability of 25, based on the 1980 CSO male table, non-smoker ultimate table? What's the probability that a 25-year-old will make it to their 50th birthday? Any guesses? 90%, 80%? What do you think your chance? Y'all aren't even 25 yet, but pretend like you're 25. What's the chances you'll make it to 50? If you're over 25, then what's the chances you'll make it another 25 years? You think it's more than 90%? You think you have a better chance than 95 make it to 50? I'm pretty sure more than 90% of my high school friends are still alive and I'm 62. I think it's more than 90, but let's see. So how would we calculate that? You can probably just tell looking at it, right? What's the probability? Pretty high, isn't it? 92%, 93%. So majority, and then 62, my old age. So that's why so many of my high school friends are on Facebook. I don't know any of them, half of them. I see that they went to my high school, so I accept their friendship. But I look at their picture in the yearbook, and I'm like, I've never seen this person in my life, but I don't think that I had a class with them. But okay, I'll accept it. But 81% of them are still alive today, and that we were 18, so you know maybe a little bit different. And then we have our high school reunion in 5 years. So 72% of them should be able to make the high school reunion somewhere around there. When does it really start dropping? So what's your life expectancy for 25 years old today? Y'all know the definition of life expectancy? What percentage make it to their life expectancy by definition? And there's not many choices. It's not 100%. It's not 0%. So what would it be? There's only one other choice. 50%. So when you go, so life expectancy at the time this table was made was about 75, 76 years. That's how you can tell it's a male table because the female table is much higher than that. All right, so it's a convenient table. You could use this to actually price your own life insurance and see if you're in the ballpark with what they're charging you. So the life expectancy, who has the higher life expectancy, a 25-year-old or a 75-year-old? Who's expected to make it to a later age, not live more years? That's what I'm asking, but whose life expectancy is higher? 75, yep, exactly, because the life expectancy of a 25-year-old we just saw is about 75 years old. But what's the life expectancy of a 75-year-old? It's not 75. You have to take this down to what, 25,300. So theirs is like 83. So why is that? Because they made it. You have those 25 years, something could happen to you. They made it, so they're gonna go further. So life expectancy at any age, you just find the number, and life expectancy is 1/2 of that number. And so it's pretty easy to go find the life expectancy. What is the probability a 30-year-old living 10 more years using only Q's? 10p30 equals 1 minus 10q30. So the answer with P's would be 10p30, the probability of 30-year-old living 10 more years. But if you only use Q's, you just take 1 minus the Q. You only use L's, it's L40 over L30. You'll see in the problems we're doing, it's pretty straightforward. But I don't do this part of the exam anymore, so you don't have that risk of having to be able to handle these. It can get a little tough. I think a lot of students understand it when we're doing it in class, and then 2 weeks, 3 weeks, 4 weeks go by, and then you have the final, and they're like, I've never seen this before in my life. It's really hard to get it fresh in your mind again. But it is somewhat straightforward if you can do it enough time. What's probably a 40-year-old dying in the next 10 years using only L's? Well, we know the people living is going to be L50. The L40 minus L50, that's a really good number to know. That's the number of people dying. I know it looks wrong. It looks like L40 minus L50 should be a negative number, but it's not. L40 is a larger number than L50. So the number of people alive at 40 minus the number of people alive at 50, that's the number of people dying between 40 and 50. That divided by L40 is going to give you 10Q40. And this is the same as this. All right, so L40 minus L50 or L40 is the same as this. And what is this? This is simply 1 minus NP40. We're assuming you either live or you die. Those are your only two choices. I'm going to skip that one. That one, I don't do these. All right. One thing you will have to deal with is joint probabilities. We don't do it quite perfectly right in this class because we only have one mortality table. But a joint probability, you do multiply. Now, there's a big problem with the multiplication. We're assuming lives are correlated. That's probably not correct. Sorry. If you have two people that are husband and wife, if they fly together, if they drive together, there is some correlation that they could both die at the same time. I'm ignoring that. I've talked to actuaries about that. I don't think they think it's that big of, because even though there is some correlation, it doesn't happen. I mean, you can think through how many times you've heard that happen. It doesn't happen that often. So
would that not play a bigger factor at the older age?
It could, but they may not actually travel that much together. You know, it's hard to say.
But
Yeah.
more of like when one spouse passes away, the other normally is gone within a few years.
Yeah, I'm pretty sure when they do joint life, they probably take that into consideration. We'll talk about joint life. For our purposes, we're going to assume they're completely uncorrelated. But maybe they don't like each other, live on different coasts, but they're still married. So Mary is 35, her husband is 33. What's the probability both are dead at the end of the year's Mary's current life expectancy? So Mary's life expectancy is 76. So we get her probability of dying. It's L35 minus L36, 76 over L35. Her husband's probability of dying, L33 minus L74 divided by L33. You get, if you do the math, it's 23.8%. Probably that individual who's 25 today will still be alive at 70. So 70 minus 25 is 45. This is part of the challenge people have is, do I take 70 minus 25 plus 1? Or is it just 70 minus 25? We're going to get into that one. That's important. If you're talking about L's, you just subtract. If you're talking about D's, you subtract and add 1 because it's at the end of the year. Just kind of get used to that. So if I ask someone 25 making it to 70, then your N is 45. did this, but I don't want that anymore. But Bill Gates thinks I want it. If I'm talking about someone dying, then I do 45 because they're going to die at the end of the year. So your end becomes, I've used 46, excuse me, I used 46 because they died at the end of the year. But we'll get into that, don't worry. All right, joint probabilities. The key on joint probabilities is the probability of them both dying and the probability of them both living doesn't equal 1, because there's 2 other choices. And you'll see this when we do joint life. They can both die, they can both live, one could live, and another die, or one can die and live. So you have 4 choices. Those 4 choices have to add up to 100%. For joint life, all we're asking is, did someone die? So all we care is if one of them dies. So if they both die, if the first one dies or if the second one dies, we're paying them. When do we not pay them? They both live. So you're going to see on the exam what we're going to do is, rather than calculating these 3 numbers, we're going to calculate the probability they both live and subtract that from 1, and that gives us the probability that 1 or both of them die. All right, you'll see that when we do joint abilities. So here's probability 2 individuals, one who's 50 today, the other 60, will both be dead in 10 years. So 10Q50, 10Q60. So L50 minus L60, L60 minus L70. You do all this, all your different L's, and you get this probability. So this is the way the exam used to be, all these type of questions, and some students just left it completely blank. They just gave up. All right, this question, the probability of a woman who's 85 today, her husband is 50. What's the probability they both live 5 years? Now you might say, when has that ever existed? So I think, didn't Liz Taylor have a husband 30 years younger? So this was in my family. My great aunt married a guy 30 something years younger. She was very wealthy. I think he was thinking she may not make it too long. She made it really long. And her and her twin sister, man, they were like the Gabor sisters. They were pretty amazing. Y'all don't know who the Gabor sisters are, but anyway, so 5P85, 5P50, so 5P85 is L90 over L85, L55 over L50. So you kind of get used to the table. When we talk about L's, it's pretty easy. You just whatever it is, the N, the 5, you don't have to make any adjustment. All right, so there's other examples in here. You can look at them. I'm not going to go through these other ones because I don't do this part of the exam anymore. So what we're doing here is we're figuring out whom we have to pay. And we're also figuring out who's paying us. So we're going to pay dyers, or we might pay livers if it's an annuity, and we're going to receive premiums from livers. So we have to figure out who these people are, who's still alive to pay. And then we're going to discount it at some rate to some time. That is the formula. So what we're going to do, and I'm going to do this in the mortality table. I don't know, did y'all find the mortality table on Canvas? You might want to look for it. So the way I'm going to do it is I'm going to do the problems below the mortality table. So I have access to the mortality table. You might try to follow along on the same line so you can kind of see what I'm doing. And I'll give you some YouTube videos that work. There's one problem that's particularly difficult. Well, there's 2 problems that are particularly difficult that you'll have YouTube videos to do some practice on. But what we're going to do is start easy, and then we're going to build onto it. What you're going to discover is we're going to have a numerator. That's the payments. And a denominator. That's the premium payers. They're both going to be discounted. I know in classes that you've discounted cash flows before, and you've probably never done this. Your mom probably told you not to, but we're going to discount people. So we're not going to just discount cash flows. We're actually going to discount people. When's the last time you took a number of people and discounted into the present? Have any of y'all done that before? It's the first time ever, right? So we're gonna actually discount something other than a dollar amount. Why? Because those premium payers are gonna pay this year, they might pay next year, they'll pay the next year, but only if they're alive. So we gotta adjust those. When you make the payments, if they're dying, you make it at the end of the year. If they're alive, you make it at the beginning of the year. When do they make their premium payments? So you pay your claims, usually at the end of the year. If it's life insurance, you're paying dyers. When do they make the premium payments? Always at the beginning of the year. So there's gonna be a 1 year difference usually. You're gonna pay the dyers at the end of the year, you're gonna get the premium at the beginning of the year. But you're gonna notice in this formula, all we're gonna do with this formula is we might have 1D or 2Ds or 3Ds or 4Ds. The premium payers might be one premium payer, 2, 3, 4, and you just gotta discount those. All right, so the formulas are not that bad at all. So the numerator is a cash outflow, usually a D, but sometimes an L. The denominator are premium payers, and we adjust it. So we adjust both of these for the time value money. That's the other thing. These payments are going to happen at the end of year 1, end of year 2, end of year 3, and the premium payers will happen today, 1 year from now, 2 years from now, 3 years from now. So you have to adjust both for those. All right, are you all ready? So let's do the very, very first one, which is really simple. Here's how I'm going to do it. You figure out how you're going to do it. So this one will not be on the exam, so it's just our first case. It's just too simple. So what premium would you charge if the face of the policy is $100,000, its annual renewal term only has 1 year to it, and you issue it to someone age 30? So we need to know who's going to pay the premium. That's L30. You got to figure out to whom we're going to pay the premium and pay the claim. It's going to be the D30s. We got to know what the face is. So I'm putting this on line 89 if you want to keep exactly with me. The dot doesn't need to be larger. Can y'all see it? Aaron, can you see that? Or Daisy, can you see that? All right. So L30, I'm going to go get L30. L30 is 99,141. D30 is 172. We see one getting the numbers. 172. The face is $100,000 or $10,000, excuse me. And the rate, be careful on exam. I tend to use either 5% or 4%, but don't assume it's 5%. You do look at the number. All right, so this is too simple of a policy, but you'll see the format of the premium. So the premium is going to equal your cash flow. Your cash flow is going to be D30 times the face divided by 1 plus the rate raised to the first. You're going to divide all of that by L30. If you want to get more precise, it can be L30 divided by 1 plus the rate raised to the 0. Why? Because they're paying the premium today. So you get used to that. But pretty straightforward. So here, the premium, we take D30, 172 times 10,000 divided by 1 plus 5% raised to the 1. All of that divided by L30. And there's the premium, 1652. You won't get this on the exam, but what you're doing on the exam can look very similar to this, so you can just have more Ds. Y'all can already see how the other Ds are gonna work, right? If it's a 2-year policy, you'd have D30 and D31, except for D31 would be raised to the second power. The L31 would be discounted to the first power. Right? You kind of see this format. The numerator starts being raised at the first power, the denominator starts at the 0, and then just add as you go after that. One's at the beginning of the year, one's at the end of the year. It's pretty straightforward. Anybody got 1652? Are using calculator? You might test your calculator, make sure your calculators have parentheses. Really helps. If you're at the investment side meeting last night, parentheses were pretty important. Doing the yield curve, bootstrapping the yield curve. All right, so you priced your first life insurance policy. Let's do another one. I'll go to line 95. Oh, people are actually answering the question. Okay. I don't know if it's right or not. All right, the second one is a level term, not one you're going to see on the exam either. You'll see why here real quickly. Ah, okay, when I do that. All right, sorry. You completely click out. It's still doing that. It thinks I want a video. I don't want a video photo. I've somehow lost my ribbon. I get it back. Oh my word. All right. 2 weeks later. You will be doing a level term on the pilot on the exam. What you're not going to get is one that's a single premium policy. All right, you won't get that. But here, what do we need? Well, it's a 3-year policy. So just get this in your notes. If it is a 3-year policy, you're going to have 3 Ds. All right, you don't have to do any fancy. It's 3 plus 1, or you subtract 1. So you're going to need D30, D31, and D32. It's a single premium policy, so only the L30s pay it. Next class, we'll do a level term where you have L30, L31, and L32, but right now we'll just start with D30. Our face is 10,000. I wish y'all could take the exam on Excel. And then the rate, again, is 5%. So I'll get my D30, 172 again. I can just copy that down, 172, 176, and 181. And my L30, same number again, 99,141. So all I have to do here is the premium. It's going to be D30 times the face divided by 1 plus the rate raised to the 1. We're just going to keep copying that. We'll do D31 raised to the what? The second. And then D32 times the face raised to the third. See how straightforward it gets? You're just doing the same thing over again. And then the denominator, it's going to be L30 divided by 1 plus the rate but raised to the 0, so that's just dividing by 1. So that's the premium. I'm gonna do D30 times $10,000. Well, I need a parentheses. Divided by 1 plus 5%. Raised to the first. Plus D31 times the face divided by 1 plus the rate raised to the second plus D32 times the face divided by 1 plus the rate raised to the third. All of that divided by L30. Still makes this like my parentheses. I don't see what's wrong with it. There's a problem with this formula, but there really isn't. I think it's perfectly fine, but I just lost the whole thing. All right, I'll redo it next class, but you see it, there's probably some parentheses probably going in there. So we'll start with this one. Where we're gonna go from here is we're gonna be pricing level term. I can't remember any other problem, but we'll see some other problems related to life insurance. We'll do some annuities. We'll do some, I don't know. We'll see the whole gamut, and then I'll tell you exactly what's going to be on the exam so you can be ready for that. All right, I'll stop it there.